Imagine investing $10,000 into the stock market. 10 years later, it's grown into a massive, sturdy tree of wealth. But even if the underlying investments succeed, many investors find themselves looking at an empty field, having missed the growth entirely. This loss doesn't require a corporate bankruptcy or a stock price dropping to zero to occur. It happens when an investor watches the price move, feels a surge of anxiety, and decides to sell. To understand how 10 years of growth can vanish in a single afternoon, we have to look at the gap between how a market moves and how a human being reacts to that movement. Michael was 30 years old when he started his portfolio, aiming to grow his career savings steadily over the next several decades. He deployed $10,000 into a broadly diversified portfolio of stocks. For the first few months, the data looked perfect. The line on his screen climbed from $10,000 to $11,000 and eventually reached $12,000. This early growth gave Michael the impression that the market was predictable and that his gains were secure. Then the market trend shifted. The line on the chart broke. It plunged from that $12,000 peak, falling to $9,000 and then continuing down until it hit $8,000. The steady upward climb he had grown used to was replaced by a volatility that he wasn't prepared to handle. Michael began checking his account constantly, watching the balance shrink day after day. Financial headlines focused on the downward slide, with analysts questioning how much further the prices could fall. Peers and friends shared their own anxieties, often suggesting that it was better to get out now than to risk losing everything. When the account hit $7,500, Michael sold his entire position. In that moment, the feeling of constant dread finally stopped. Selling feels like a protective measure during a crash, but it carries a specific consequence. It turns a temporary drop in price into a permanent loss of capital. Now holding cash, Michael watched from the sidelines as the market eventually bottomed out and began to climb back up. Prices moved back to $8,000, then $10,000, and reclaimed the $12,000 level. Michael saw the growth, but stayed in cash, waiting for a definitive signal that the market was safe before risking his money again. But the market doesn't provide a clear, risk-free moment to return. By the time it feels safe, the opportunity for recovery has usually passed. When he finally did reinvest, he had to buy the same stocks at much higher prices than where he sold them. By attempting to time his exit, Michael guaranteed a result of selling low and buying high, which works directly against the goal of long-term wealth. These cycles suggest that the stock market is less a test of financial intelligence and more a test of emotional regulation. Investors deal with the pressure of greed at the peaks and the weight of fear at the troughs, both of which can drive impulsive decision-making. Michael eventually shifted his approach, moving away from the attempt to predict when the next market move would happen. He began to focus on his own inputs, his savings rate, the frequency of his deposits, the diversification of his holdings, and his total time horizon. Success in the market often comes from ignoring the movements you cannot control and strictly managing the behaviors you can. Maintaining that discipline over a long enough period leads to the mathematical effects of compounding. Compounding is the process where your returns generate their own additional returns. Over decades, this creates the exponential upward curve seen here, where small gains eventually snowball into much larger returns. However, this curve is sensitive to interruption. When an investor sells during a panic, they break the cycle and force the compounding process to start over from the beginning. Building wealth requires having a plan in place to handle market stress before that stress actually arrives. When prices fall, the most important question isn't how to escape, but whether the reasons you invested have changed. In the long run, the market tends to reward those who can remain patient while others are panicking.